Feel like you should be rebalancing your portfolio or moving money around, but nervous to do so because the market is a little, well, gestures at everything? Let's talk about the pros and the cons.
Rich Girl Roundup. Love it.
Welcome back to Rich Girl Roundup. We will take listener questions every month on Instagram, so follow Money with Katie on Instagram if you're not already. And as my standard disclaimer, I am not a licensed financial professional. This is not financial advice. This is just what would Katie do in your shoes. This week's question is from Taylor. Dear Katie, many moons ago, I took some bro advice. I know, I shouldn't have, but it was bro advice from my literal brother, who, to be fair, is pretty good at money, so it is what it is. Anyways, he was very into the stock market and bro podcasts with little nuggets about things that could affect it, so I bought a handful of individual stocks per his recommendation. Fast forward, I am a rich girl doing rich girl things and have accepted I will never be an individual stock girl. I'd really like to transfer everything over to a robo-advisor that will manage it for me. However, with the current state of the market, my stocks have seen better days. Does it make sense to try to wait it out till they're performing better, or should I just bite the bullet and transfer it over? My cumulative return since I funded the account is 8.51%, so I haven't lost money, but it has taken a pretty considerable dip since earlier in the year before the market started turning, so it certainly feels like a loss to cash it out at this point. Who amongst us hasn't dabbled in individual stock picking? Though I will say, Taylor, you said you don't think you're good at this, but if your portfolio is still up 8.51% after the last 12 months we've had, you actually might be better at it than you think. Now, I wouldn't recommend trying to extend your streak of W's because it's very hard to keep winning forever, but I commend your growth and your courage to get some skin in the game. So let's talk about the pros and cons of liquidating positions when they're quote unquote down. I use air quotes here because when we're talking about individual stocks, holding longer doesn't necessarily mean we are going to see them regain their former highs. For example, Cisco stock peaked around $77 during the dot-com bubble in 2000, and it has never been that high again. Today, it trades for about $44. The point is, as investors, we tend to anchor to the price we pay as the real value and view anything above it as a good return and anything below it as a low. In reality, the fair market value or the fundamental value of that security may be nowhere close to what we paid. Someone who wanted to hold on to their Cisco stock after the dot-com bubble burst until it regained its pre-crash high instead of diversifying into, the S&P 500 would have missed out on one hell of a bull run and still would not have reached their former all-time high to this day 20 years later. All that to say, the fact that you've actually gained 8% on your individual stock investments, to me, and this is not financial advice, but rather a consideration for your decision, is a bit of a take the money and run moment. The con that you don't know if they'll reach their former highs if you sell now is certainly a possible scenario, but the pro is that by cashing out now and transferring to a robo-advisor, you'll get to buy all the broad-based, low-cost index funds at a price that's relatively lower than you would have paid this time last year. Now, like we said, that doesn't necessarily mean it's a fair price, and some people still insist that the S&P 500, for example, is still overvalued. But as far as rebalancing opportunities go, big downturns tend to be good times to secure new, more fairly priced positions in major indices. Keep in mind, too, if you purchased these individual stocks less than a year ago, that is fewer than 12 full months ago, you'll pay short-term capital gains taxes on your returns when you sell them, which is, for all intents and purposes, your marginal tax rate. And if you've held these stocks for longer than a year, you'll pay long-term capital gains taxes on your returns, likely 15%, unless you earn more than the mid $400,000 range after accounting for the investment income. So just some tax specifications to be aware of.